So, January was a bit of a wild ride for the US markets, wasn't it? One minute we're hitting these incredible all time highs, and the next, a sell off has everybody feeling on edge. If you've got a bit of whiplash from all that, trust me, you are not alone. So, in the next few minutes, we're going to break down exactly what happened, what to keep an eye on in February, and, most importantly, what you should actually do about it. Let's dive in. Right. That now what feeling is completely normal. The headlines, they just swing from record highs to sell-off warnings in a blink of an eye. Our goal here is pretty simple. We're going to cut right through all that noise and give you the clarity you need to navigate February with some real confidence. Okay, so what really happened in January? Let's start with the numbers because honestly, they paint a fascinating picture of a market that's really at a crossroads. Now, at first glance, you might look at this and think, okay, pretty flat. But the real story here is the journey, not just the destination. The S&P 500 actually climbed above 7,000, and the Nasdaq was flying high, well over 23,800. But then, a late-month sell-off just wiped out pretty much all of those gains. So most investors were left right back where they started the year. So you're probably asking, what caused that choppy ride? Well, it wasn't just one thing. It was this classic tug of war in the market, with some really positive news on one side and some broader economic worries on the other. Let's break down those opposing forces. So on one side of the rope, you had some seriously strong earnings reports, especially from the giant tech companies. Apple, in particular, just posted fantastic results, and that gave the whole market a real shot of confidence. But pulling hard in the other direction were these renewed worries about trade tensions with Europe. That kind of spooked investors, creating a risk-off mood that really triggered that sell-off late in the month. The other big battle was between the economy itself and the Federal Reserve. Think of it like this. The economy is a car that's finally slowing down to a safe speed, but it's not stalling out. The Fed, who's in the driver's seat, saw this and decided, okay, let's just take our foot off the accelerator for a minute, so they paused their rate cuts. And that signaled to investors that the road to lower interest rates might be a little longer than everyone was hoping. Let's look at the specific gauges the Fed was watching. First up is inflation. The annual core CPI is sitting at 2.6%. Now that is getting closer to the Fed's magic number of 2%, but we're just not quite there yet. And this is a huge reason why they're tapping the brakes on those rate cuts. They want to be absolutely sure that inflation is under control before they start making it cheaper to borrow money again. Next, you've got the job market. The unemployment rate is at 4.4%. And this shows that the labor market, it's cooling off from being red hot, but it's not freezing over. People are still getting jobs, which is a really solid sign for the overall health of the economy. So you put it all together, inflation's still a little bit sticky, the job market's holding up, so the Fed decided to hold the line, keeping the federal funds rate in this range right here. The message to investors was loud and clear. Don't expect a flood of cheap money to come rushing back into the system just yet. All right, so with January in the rearview mirror, what should we be looking for in February? Well, the market is going to be laser focused on a few key data releases to try and get a better read on where the economy is really headed. Here are the dates to circle on your calendar. February 6th, we get the jobs report. Is the labor market still holding strong? Then on the 11th, we get the big one, the CPI inflation data. The question is it continuing to cool down? Then on the 18th, we'll get the minutes from the Fed's last meeting, which investors will just pore over, looking for any little hints about the future. And finally, on the 27th, we'll see producer prices, which can give us a clue about where consumer inflation might be going. Each report is another piece of the puzzle. And that brings us to the most important part of this whole explainer. What should a beginner actually do right now? When the market gets this choppy, the best moves are often the simplest and the most disciplined. Okay, before we get into the steps, we need to talk about something called portfolio drift. Imagine you bake a pizza that's supposed to be perfectly half pepperoni, half cheese. But the pepperoni is so good, it kind of puffs up and starts creeping over onto the cheese side. Well, that's what can happen in your portfolio. When certain stocks, like big tech, do really, really well, they start to take up a bigger slice of your investment pie than you originally intended. And that can sneakily increase your risk without you even realizing it. And this visualizes exactly what I'm talking about. Let's say you started with a nice, balanced 70-30 recipe for stocks and bonds. But after a great run for stocks, you might check your account and suddenly you're at 80-20. You didn't do a thing, but the market's movement has changed your recipe for you. So how do you handle this? Well, it all comes down to simple discipline. First, just stick to your plan.
If you're making regular contributions, keep doing it. That's dollar cost averaging at its best. Second, check for that portfolio drift we talked about, and maybe think about gently rebalancing back toward your target. Third, if you're just starting out, build a strong foundation with a diversified core, like a total stock market fund. And finally, probably the hardest rule of all, you've got to tune out the daily noise. Don't let one scary headline derail a plan that's meant to last for years.
You see, all of these actions are really powered by just one thing: your mindset. When it comes to investing, your patience and your perspective are basically your superpowers. They are so much more important than trying to predict what's going to happen next week or next month.
So I want you to ask yourself this one critical question. When you see the market swinging around like it did in January, are you seeing a fundamental signal that your entire long-term plan is wrong? Or are you just hearing the short-term noise of the market doing its thing? For almost every single long-term investor, the answer is simple. It is just noise. If your financial goals are a decade or more down the road, the daily and even monthly swings are really just bumps in the road on a very, very long journey. So here's how you put that long-term mindset into practice. First, always keep your time horizon in focus. Are you investing for next year or for the next 20 years? Second, create a simple process for yourself, like a quick quarterly check-in, instead of trying to react to every bit of news. And third, set your rules of engagement before the market gets crazy. This is what's going to keep you disciplined when emotions are running high for everyone else. And let me just leave you with this one final thought. 10 years from now, in 2036, are you even going to remember the specific ins and outs of January 2026? Probably not. What you will remember is whether you had the discipline to stick with your plan and just let your